In the past 18 months, central banks have increased interest rates at the fastest rate for over 2 decades. Yet, defying the Bank of England's own dismal predictions of recession, the UK economy has stumbled along, with a recent upward revision of GDP stats. Across the pond, last quarter the US economy grew at an annualised rate of 5%. The long-awaited recession doesn't seem to be in sight. But is the worst really over? Or do these historic interest rate rises create hidden threats to the economy in the coming months? Looking back, the period from 2009 to 2022 was really quite extraordinary. Near zero interest rates, which encouraged a booming bond market, rising asset prices and rising debt levels. The problem is everything which benefited in a zero interest rate environment is now struggling with the exact opposite. Last month, the Bank of England paused interest rate rises, but perhaps the most significant piece of their presentation was that they expect at least 2/3 of the effect of higher interest rates in reducing consumption to still come in the future. The Economist recently warned that the foundation for today's economic growth looks unstable, with threats abounding. These are 7 threats which face the UK economy. The most obvious impact of higher interest rates is on mortgage rates. In the UK, these have almost doubled, and this has impacted household finances and homeowners who face soaring mortgage costs. This has impacted household finances as homeowners face rising mortgage costs as a share of income. And importantly, many homeowners are still to remortgage to the higher rates. Borrowers have been insulated by fixed-rate mortgages, and in the coming months will face quite a shock as interest rates go up, reducing their disposable income. And the effect will be quite unequal. Younger, recent mortgage holders will be most affected by the rise in interest rates. Also, worth briefly mentioning that the recent rise in house prices and size of mortgages means that interest rates of 5% have a much bigger impact in reducing disposable income than they did in the past. Later we'll also see how these higher interest rates could affect house prices in 2024. But a second hidden threat to the economy is in the form of disguised austerity. Government spending plans are still set from when inflation was much lower. If inflation is much higher than expected, it means that government budgets should need to increase to face the costs of higher inflation. But this hasn't happened yet. The Resolution Foundation report that government budgets are based on unrealistic expectations that real spending can be cut quite dramatically. To put it into context, unprotected departments like education, transport, home office and justice will see their spending power fall 16% in real terms between 2023 and 2028. This is as severe as the austerities of the 2010s, if not more so. And it comes at a time of serious backlogs in the criminal justice system where we need more investment. And it's very difficult, with budgets squeezed so tightly, to find more real spending cuts. Another concern is that we've seen a big fall in the savings ratio. The stronger than expected growth has at least been partly due to people dipping into their COVID-era savings. But there's a limit to how much you can boost spending by dipping into your savings, especially for many of the lower-income households who are living paycheck to paycheck. There is very little room for manoeuvre, especially given the cost of housing and day-to-day living. Now, the inflation rate may be falling, but that doesn't mean prices will go back to 2020 levels. It just means prices are growing at a slower rate. Inflation will continue to be a big impact on the economy in the next year, even if it falls. A second impact of higher interest rates has been turmoil in the bond market. As interest rates rise, the price of bonds falls. There's an inverse relationship between the two. Now, the sharp rise in bond yields has caused the price of bonds to fall around 25%. And this has really negatively affected those who are about to retire, because traditionally as you get close to pension age, you move your savings into bonds, and this is what many pension funds have done. Bonds are supposed to be a risk-free investment, but if 80% of your pension is in bonds which are falling in value, then the value of a pension will also decline. And this is a big issue for the baby boomers who are now pension boomers, coming into their pension, but with turmoil in the bond market. Now, to a limited extent, higher interest rates will benefit pensioners through higher dividends, but we still face a situation of negative real interest rates, with inflation higher than actual interest rates. So it means that savings are reducing in real terms. So the UK pension market is still quite exposed to the fall in bond prices. If we go back to September 2022, you might remember the sudden jump in bond yields almost caused the pension funds to collapse until the Bank of England intervened, and this is because they'd bet so heavily on interest rates staying low. And because of their losses, they're having to sell quite a few real estate assets at a discount of up to 40% to maintain their cash flow. The third cost of higher interest rates, and one that's not necessarily immediately obvious, is that it will affect the government's own fiscal position. When interest rates rise, the cost of debt interest payment goes up. The UK saw a surge in debt interest payments last year. This is for two reasons. Firstly, higher inflation. The UK has a lot of index-linked bonds, which means when inflation is higher, the government pay more debt interest payment. And also the higher yields themselves will push up borrowing costs. And this is very important because for many years we got used to very cheap government borrowing. But now debt service payment will take a bigger share of GDP, equivalent to almost the entire education budget, with a risk that it will continue to rise, and this will severely limit the government's fiscal position. Unlike the 2010s when borrowing was cheap, rising bond yields mean the government have to be very careful. There's only so much that they can increase deficit, increase borrowing, increase spending. Government debt has passed 100% of GDP, the highest level since the 1960s. And this problem is exacerbated by the slowdown in economic growth we've seen really since 2010. The UK growth has really fallen behind, and productivity growth is very disappointing, and there seems to be no end in sight to this. Higher interest rates are here to stay, and it severely limits the amount that governments can borrow, especially with demographic factors such as an ageing population on top of a weaker growth. Now, another issue that you may not have even heard of, but is significant, is that in the 2010s, the Bank of England bought a lot of bonds as part of quantitative easing. Initially, this was actually quite profitable because interest rate costs were very low. But now that interest rates have increased, the Bank of England is actually making a loss. And furthermore, it's now trying to sell these bonds through a process known as quantitative tightening, selling off of bonds onto the market. This is a significant share of GDP, but it's leading to a loss. The FT report that the Bank of England is already making losses of around £24 billion, and this could rise to £100 billion. And this will be a loss which will ultimately be faced by the Treasury and you, the taxpayer. Now, when we talk about the effect of higher interest rates, we instinctively talk about mortgage holders. But actually, higher interest rates will have a big effect on business, company financing. When interest rates go up, it will also mean higher borrowing costs for business. And at a time when business failures are already starting to rise, higher borrowing costs on top of this will be an added pressure to their profitability. The high street already face a difficult time, with shoppers staying at home, causing the likes of Wilko to go bankrupt, and this creates a loss of confidence in towns and high streets. And the interest rate cycle remaining high and real estate not doing very well, then it causes problems for all the businesses that are trying to struggle and stay there. Also, next year, we're likely to see positive real interest rates for the first time in 20 years. But how will people and business cope with interest rates higher than they've been for like 20 years? Now, it's always easy to talk about the negative and dismal threats facing the economy. Is there any good news on the horizon? Well, I think that the fall in inflation, although rather belated and took longer than we'd have liked, it is going to help. Firstly, real wages are rising for the first time in many months, and this will be an important factor in maintaining consumer spending next year. If inflation keeps falling and nominal wages try to catch up the lost real income of the past few years, then this could hopefully increase real incomes and strengthen the economy. Also, the fact that inflation is finally starting to fall does mean that the worst predictions of mortgage rates rising look to be not quite as bad as we first feared in July. Mortgage rates have actually slightly fallen as markets are pricing we're close to the peak of interest rates. But that doesn't mean the housing market is fully adjusted to the new climate of higher interest rates. UK house prices are still overvalued by historical levels and with a new interest rate environment. This video goes into more detail on how overvalued the UK housing market is and what impact this will have on house prices and the wider economy. Thanks for watching. Please subscribe. See you soon.